my name is Mike Fehrenbacher, and today I'm going to talk a little bit about mortgage protection. Mortgage protection, there's really two different types of product on this. It's not a lot of different products, but there are two different types. The first one is a straight term, and the second one is what they call a return of premium. The straight term is the most cost-effective way to get the maximum coverage for the lowest premium. The downside of it, should you pass away, or the upside of it is, should you pass away, regardless of how long you've been in the plan, it will pay the full benefit. The downside of it is, should you outlive the term, it doesn't return any money back to you. The return of premium is about 1.5 to 2 times more than the straight term. What it is a product that came out probably 8 to 10 years ago, and it allows consumers the opportunity, should you outlive that term, to recoup all your money that you paid into it. It'll pay you every penny that you paid into it. So that's a great thing. The downside to that is the majority of Americans stay in the term policy 7 to 10 years. It's how it is. It's the numbers. So if you want to roll the dice and you get out of it early, they don't return any money back to you. So that's going to go into my next thing of affordability. Or topic of affordability is, you want a plan that's going to meet your needs, your wants, but also your affordability. It's great to get a plan that's, the Cadillac of plans. It's costly, and the first 6, 12, 18 months you're making all the payments, but then it becomes a burden. Guess what? You drop the plan, you lose the money, you got to start over. So sometimes I tell people, scale back a little bit. Even if you cover 50% of the mortgage, you still have your spouse that's going to receive the other benefit, and they're going to be there, and they can still continue to make their income based off that. With that mortgage protection policy, they can continue to make the payments. So when a spouse does survive, like I said, they do pay the full premium, but they will also, you don't have to pay off the mortgage in full. You can take that money, put it in the bank, and along with the money that you're making, use a portion of it to continue to make your mortgage payments as needed. It can also then help you with the replacement of the income that's lost with that loved one. The age groups vary, but typically if you buy a house, you're eligible for the plan. They normally cut off right around the age of 50, 55, maybe 45. But when you start winding down and you start getting over the age of 50, the mortgage gets paid off. You don't need it. And then the last issue you have in your life is probably paying off your funeral, which a lot of people convert to the whole life final expense policy. So 22, 23, 24, when you qualify for that mortgage, the great thing is it's super, super inexpensive at that age. Lock in a 30-year term. My personal self, I suggest the straight term, and buy term, invest the rest. That's the policy that I believe in. The different carriers, the carriers do have different premiums associated with who they are. Mutual of Omaha is different than American Amicable, which is different than Transamerica. So I deal with a lot of different carriers out there, well over 25 of them. And based on your age, your gender, your tobacco use, and your overall health, one carrier may suit your needs better than the other. And that's the advantage of using a guy like me, is that I'll find the maximum coverage for the lowest premium. And again, the cost does vary. The younger you are, the less expensive it is. And as you grow older and wiser, the cost does increase each and every year that you become older. If you smoke this year and you stop smoking and it's been 12 months, you're eligible for a non-tobacco. That's a common question. Hey, I smoked 2 years ago. Is that still okay? Yes. They look at 12 months worth of history on your tobacco. So qualifying, just like anything else, I got licensed in 1993, and mortgage protection was actually the first product that I sold even before mortgages. And it's a great product. It was here in the 90s. It was here before me, and guess what? It's still here. Everything is streamlined now, even the qualification process. Back in the early 90s, a nurse did come out and conduct a full physical, regardless how healthy or unhealthy you were. Today, If you're overall healthy, they do streamline the process. And if you're unhealthy, you can still get qualified by taking the physical, and then the carrier has the right to whether they want to offer you the protection or not. So qualification is streamlined. It's not a bad thing. It's just everything's automated and updated with the MIB. So they do streamline to where if you're healthy, a nurse doesn't need to come out and do a physical. So again, mortgage protection is a great product. It's inexpensive. Just make sure you stay within your affordability factor. But in the same note, you're covering a majority of, if not all, of your needs at once. And if you have further questions or you're looking for coverages, put mortgage protection in the subject line. Shoot me an email at Mike, M-I-K-E, Fair, F-E-H-R, the number 15 at Gmail, MikeFair15 at Gmail, or shoot me a text or a call, 312-600-4410. This is Mike Fehrenbacher on mortgage protection. Have a great day.